Hi everybody, in this video we're going to complete problem AP16B in chapter 2. And in this problem we have a medical clinic that started operations in January 2017. And let's see, we've got the opening balances as of January 1st, 2018. And let's see, so this business has basically, been open for a year is what we're saying here, more or less. And we've got beginning balances, and we've got transactions that have occurred, and we're going to be recording these transactions in the T accounts. So with that said, let's come down and take a look. Again, in this problem, we need to input the T account name, so I'm just going to do that real quick. Again, one way, actually with this one, since we already have beginning balances, we can basically just take those accounts that already exist and go through, because we will definitely need those accounts. I don't believe there's any new accounts that we would need that are not already represented. So we can just use our beginning balance, our opening balances kind of to guide us on what the accounts could be. Oh, no, sorry. There is one new account, unearned revenue, that we didn't have yet. So I will input that. Okay, and finally, sorry, we gotta do that. Let's do our income statement accounts, our balance sheets. We've got service revenue. And as far as expenses go, we've got interest expense. We've got maintenance expense. I'm just going to put EXP to represent expense. Rent expense. Salaries expense. Travel expense. And finally, utilities expense. Okay, and that's all of the that is all of the accounts that we are going to need for this problem. And so let's get started in with doing the actual work. So step one, just like we did before, we want to go through and put all of our beginning balances in. And those are just, we can pull those off the list above. And let's see, accounts payable. So as we noted, unearned revenue will be a new account just that happens during the month of January that we're going to record. We don't have a balance in there to start. And there we go. Okay, so that takes all of the accounts, our opening accounts up here, and inputs those. And now we're going to go through and look at all 12 of these transactions and record those into our T accounts. Okay, so the first transaction is that we purchased plane tickets with $1,500 cash. So right off the bat, we can see we have a reduction in cash of $1,500. And the plane tickets are to attend a business conference. And so we've got travel expense that we're going to debit, or sorry, we're going to increase by recording on the left side of the T account. We paid $3,000 cash to reduce the amount of an accounts payable. So again, we're going to reduce cash and we're going to reduce accounts payable. So remember that we're decreasing liabilities on the left, decreasing assets on the right. So it all balances. We invested $5,000 into the company. So a contribution or investment there into the company, which is going to increase cash for the business and be recorded as an increase to owner's equity. Purchased $4,000 of equipment with a bank loan. So we had an increase in our notes payable to reflect the new bank loan. Paid $1,000 for maintenance expenses, so cash reduction, and then maintenance expense. We're going to record an increase in maintenance expense for $1,000. We paid cash. We earned $15,000 revenue on a cash basis, so we were paid $15,000 in cash, and we record revenue for that as well. We received a $900 bill for utilities, and we issued a check immediately to make the payment. So we don't record, we got a lot of times when the bills come in, it's going to be paid later, so it will be recorded more as a payable, a liability, accounts payable, etc. But in this instance, it says that we paid immediately, so we just reduced cash instead of recording a liability. Recognize $2,000 of prepaid rent as an expense. So we have a beginning balance of prepaid rent of $6,000, but we're using up $2,000 of that this month. So we're going to reduce that prepaid rent and record $2,000 rent expense. Paid $100 interest for the month with cash. So we're going to reduce cash, and this is interest expense of $100. Paid $4,000 in monthly salaries. So that'll be a salaries expense, and again, a reduction in cash. Received $2,000 from one of its clients for services to be provided in March. So we got the cash. We have not yet earned that revenue, so we're going to record that into unearned revenue. So an increase in that liability for services to be provided in the future. Got the cash, still need to provide the services in the future. So until we earn that cash, it's unearned revenue. That's a liability. And finally, the owner withdrew $2,000 for cash from the business to pay for personal expenses. And so we're going to record that as a withdrawal, and it's a reduction of cash. And that's all of the transactions. And so we can come through here and see, now we need to do a bunch of math basically. And so just like we did before, you take your opening balance plus your increases minus all these decreases. And if you do all that math, you will come out to $24,500 ending balance in cash. So this plus all these minus all those. I can do this math pretty easy. Prepaid rent comes down to $4,000. Started on the increase side, $6,000. We reduced it by $2,000. Prepaid insurance, we had no transactions. Equipment, we had an addition of $4,000. So that's actually put $40,000, but that's $4,000. This is now zero because we had opening, but we paid it off in full. $2,000 liability for unearned revenue. $5,000 liability now. I say not 5,000, 14,000. Yeah, notes payable. We've now got 48,000 in capital for equity, and then we've got just the 2,000 in our withdrawals. On the income statement side, for revenues and expenses, we just have basically one. Nothing really to add, but we can just bring down these totals for completeness. And then easy to get revenues because it's just listed up there, 15,000. Total expenses, we're going to add all those, 900, 1,500, yada, 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 so on and so forth. And that gives us 9,500 if we add all these together, all the expenses together. And then if we take our revenues minus our expenses, it leaves us with $5,500 of net income. And then finally, we want to come over and add all of our assets up. So if we add all these ending balances together, 24,500 plus 4,000, 5,000, 34,000 gives us 67,500. If we add all these liabilities up, it should give us 16,000. And then owner's equity, we're going to have 48,000 minus the 2,000 we took out through the withdrawal, and then plus the 5,500 that we earned in net income, and plus the 5,000 that we contributed into as an investment into the business. So taking all those together gives us 51,500. So 48,000, beginning balance of 43,000 plus the 5,000 investment minus the 2,000 withdrawal plus the $5,500 net income. And then if we take 16,000 plus 51,500, we end up with 67,500. And we can see here that our assets equal our liabilities plus equity, the sum of those two equaling that. All right, so our T accounts are complete. And the next step we're going to go into is to prepare the financial statements here. And so step one, we want to prepare the income statement for the month of January. So we'll put the name of the business at the top. Then we'll put income statement for them. Remember, this is the income statement, so it's not as of a specific time, but it is for the whole month into January. If I can spell right, January 31st, 2018 in this instance. Typically we center those. That's kind of, the formatting is a little funny here. I'm not sure exactly how to format in this. There might be a way, but I'm just leaving it to the left side here. It's fine. Okay, revenue. We have service revenue. And basically we're just taking this information from over here. So our total service revenue is 15,000. And then we'll look at our expenses. So again, basically just taking all of our expenses off the totals for the ending balances of the account. And we have interest expense, maintenance expense, rent expense. I'm just doing EXP to represent expense, just to save a little time here as we're going through this. Travel expense and utilities expense. And then again, we're just going through, and a lot of this is just sort of formatting. It's, we have all the information above. We already did all this work more or less, so we're just bringing it all together into our income statement report for the month of January. 1,500 and then 900. And so the total of our expenses here, let's say total expense is, adding all of these together gives us the 9,500. And then again, as we already kind of saw above, we've got net income here, right, 9,500. So net income of 5,500. And that's great. Okay, so that's the income statement. And then we want to prepare the statement of owner's equity. So I'm just going to save a little time by copying and pasting the name. Statement of owner's equity for the month ended. So it's a full time period. It's not just as of a date like it is for the balance sheet. And then we're going to basically break out the activity in equity during the month of January. So our beginning balance was 43,000, and we're going to add the investment in of 5,000. We're going to add net income from above here, 5,500. Then we're going to subtract the withdrawal of 2,000. So plus this, minus this. And then our ending balance at the end of 2018 comes out to the 51,500. And that's, basically what we showed here. 51,500 is just breaking out the components of how we got to that place. Okay, finally, let's prepare the balance sheet. So we've got, again, the name. This will be our balance sheet. And now this one will be as at January 31st, 2018. So it's at that point in time. It's not over the full month like we put for the other two reports, but we put specifically at a point in time. The very end, ending point of January. So we just want to put all our assets, liabilities, and equity accounts here. So I'm just going to go through and list all the asset accounts that we have. Okay, and then I'm going to put the amounts in here: $24,500 cash, $4,000 for prepaid rent, $5,000 prepaid insurance, and $34,000 for equipment. And then let's sum all those up to give us $67,500. And then on the other side, we have our liabilities and equity. So we have accounts payable. And we ended up with a zero balance in there. Unearned revenue liability of $2,000. We received cash that we had not yet earned yet. Notes payable, ending balance of $14,000. And then we get total liabilities, adding those together, of $16,000. And then in terms of owner's equity, we have the one owner, Kate's, the ending capital account there is the $51,500 that we calculated above. So we bring that over, and then we finally add total liabilities plus owner's equity, and we add these, the $51,500 to the $16,000, and that gives us the $67,500 that matches assets equal liabilities plus equity, $67,500. And there's a little more formatting you could do. If this was in an Excel, you'd want to make this look better if you're actually doing these reports. But for purposes of just inputting into the spreadsheet here, that's basically how it all comes together. So thank you so much, and I will see you in the next problem. Bye, everyone.